Okay, so you're sitting on the sidelines and you're saying, Dan, I know there's a housing crash here. There's one coming, or there's one coming eventually. And now we see rates in the 7s. I'll never be able to buy a house. So if that's you, well, please continue to watch this video, because my name is Dan Free. I do this video on a daily basis to inform you guys the facts behind real estate. And why do I emphasize the facts? Well, you remember back in 2020 and then 2021 and then 2022 and then 2023, everybody's like saying, if you buy a home, you're probably the dumbest person on the face of this earth, because don't you know the housing market's going to crash? Okay, so I wanted to really dive into this topic. So where I started with this is I went over to CNBC, and this just popped up today, believe it or not. And it says, home prices may be turning lower. Well, haven't they already been lower? Haven't they crashed like everybody's telling us so? Well, so I figured I would dive into this topic because we're about 2/3 of the way through the year. I made a prediction at the beginning of the year saying the housing market is going to be absolutely flat. However, there's going to be some markets that are up a little bit. There's going to be some markets that are down a little bit. And there's going to be some markets that are down considerably. Those markets might see about a 10, 12, 13% decrease in values. Well, how did my predictions go so far? Well, let's get over to the housing data. So you can find this data if you go to Zillow, research, and then data. These are the top markets right here when it comes to buying real estate. Okay, so it starts with Hartford, Connecticut, up 5.6% year over year from 2022 to 2023. Yes, there is still houses appreciating. You can see Connecticut, Virginia, Pennsylvania, Florida, Wisconsin, Ohio, Missouri, Maryland, Ohio, and the list goes on. But remember those areas that I said are going to be hit? Well, let's see how I did there, because I said most markets are going to see 0, maybe up 3, 4, 5%. Okay, but then you're going to have markets that are down maybe 10%. Well, I called it so far. You have Austin down 10%. That's what we're going to focus in on. But let's look at some of these other areas. Phoenix, Arizona, Las Vegas, San Francisco, Sacramento, Dallas, Raleigh, San Jose. These are the markets where I even said in my videos specifically, Austin, Phoenix, Las Vegas, San Francisco, and Sacramento are probably going to see 10% reductions. And I missed it. I missed it on a good way because they're not down as big as Austin. So let's go over and really dissect Austin. How bad is Austin? Well, if you go to this section right here, and this is basically Norada Real Estate Investments, Neighborhood Scout data shows that Austin real estate has appreciated 196% over the last 10 years. 196%. So then you might say, well, Dan, I'll just give you when I see this, I know these are going to be the biggest markets to take that hit. Okay, so if you look at that, that's on average, I don't know, which is an average appreciation of 11.47 a year. Okay, so it's not 20% a year because it wouldn't uptick that way, but they're having 11% appreciation every year for the last 20 years. The norm is like 5, 6, 7%. Okay, so they're way above the norm, and they've seen, again, in the last 10 years, they saw a 200% increase in values. Okay, so you look at that and then you're saying, okay, that's why it's taking the hit. Because, if you came to me and said, Dan, I'm going to take 10% away from you, but we gave you 200% over the last 10 years, I'd be high-fiving somebody. I'd be so excited. So I want you to understand, you really have to focus in on the data. Don't be one of those followers of YouTube channels and mainstream media when they're trying to pump this agenda and the reason why they're pumping this agenda is they need your views. They need your views, folks. They don't care if the information is accurate or not accurate. They know they're going to have their sheep following them, but they continue to say the housing market is crashing, crashing, crashing. Unfortunately, the data isn't telling us that. I predicted this, and let me explain to you why. I've been in the mortgage business for 30 years. I've seen probably 60% of homeowners, 80% of homeowners back in the last 5 years refinance at rates 4% or below. So then I'm thinking, okay, you're in a rate of 3 or 4%. Rates went to 7%. Unless you have to sell your house, like people had to do in 2008 based on subprime mortgages crashing the entire market, that's what caused the crash. But if you're in a fixed rate at 4% and you don't have to sell your house, you don't have to fire sell your house. So my expectations were a lot of people aren't going to sell their homes. I focused in on home builders, seeing that home builders started really pulling back. So I'm like, okay, there's going to be really dismal demand for housing, but there's even going to be more dismal, basically, supply. So you have this lowered demand with lowered supply, it's going to keep an equilibrium on prices. Okay, people aren't going to have to fire sell their house. They don't have to sell their houses, so you have to buy a house that's being built at this time. That's why a lot of times I focus on home building stocks and home building companies based on this information. But I just wanted to give you that data just to kind of throw that in there. Next, let's talk about mortgage rates. I've been a proponent that mortgage rates should be in the range of about 5.5% to 6%. I called that at the beginning of the year. I am off so far year to date, but we still have a third of the left of the year to come. And okay, maybe I might miss it by a month or 2 or 3 or 4. But when you look at it over time, I started in the business back in the late 80s where rates were, 15 to 20%. And I lived through this time where mortgage rates were 2.5%. If you look at this, the average over the last, say, 20 years, it's about 5.5%. That's the norm. So until the Federal Reserve got involved in 2008, when the housing market imploded, let me just dissect that a little bit to explain to you guys what happened. So back in about the early 2000s, the administration in check at that time basically was like, everybody needs to have a house. Okay, so they started creating all these products to help people get into homes, and then the subprime market kind of took over, and they were offering 100% financing for people with credit and no jobs. You didn't even have to validate your job. So what happened with all those people? They got into the FOMO. They started buying real estate on all these teaser rate programs and all these subprime mortgages to then find out, well, when the market stagnates, and if you really did your research on these mortgage products, if the people did their research on there, they would have never got involved in these products. But what happened is, over the past from 2000 to about 2005, a lot of people's mortgage payments tripled. They tripled. Okay, well, again, when you qualified for the mortgage, you didn't have to really validate you even had a job. So a lot of these people they could hardly afford the payments that they had at the time, but then when the mortgage payment tripled, they couldn't afford the house. So what they have to do? Well, they either had to go in foreclosure or they had to sell the property. So you had masses of homes on the market and going through foreclosure. You had a glut of homes hitting the market. So now it's a feeding frenzy. People just start coming in, buying houses at the rock bottom. If you bought at that time, you're killing it right now. So that's basically what happened. Okay, so now what we're seeing is the Federal Reserve stepped in and they're like, okay, inflation is way too high. Well, they've created this bubble, and as well as the federal government created this bubble. So now what do we have to do? Well, we have to jack rates up to the moon to start halting all this buying of real estate and buying of stuff. So they've artificially raised rates during this time frame, and then until rates settle down, and I'm still saying it's going to be another 6 to 12 months before the rates settle back down to 5.5% to 6%, but it will. So right now, the savvy investors are saying, okay, I don't really have bidding wars out there with 100 other people looking to buy this property, because I can buy today, and then based on history, right through here, I can refinance at some point at a lower rate. Because you always see these spikes that we have in rates through here. You had a reprieve down here, you could refinance. You go through here, then you have a reprieve, you can refinance. You buy here, you can reprieve. I'm not saying it's always going to go down, but you have to know the reasons why rates are where they are. So today, based on this information, let's get over and see where the bond market's taking us to see where mortgage rates are going. So this is what I follow on a daily basis. A lot of you guys might say, okay, Dan, yes, you follow the 10-year. No, I don't follow the 10-year. I follow the MBS market. This is a mortgage-backed security bond. Why would I follow a 10-year government treasury when I can follow a mortgage bond? Okay, so what this data is telling us right through here is where the price of the bond is and what's going on with that price. Okay, all you need to know with this is Bond 101. If the price goes down, which you're seeing in this case, rates or yields go up. So this is probably going to equate out to rates going up about 0.08, maybe 0.1, okay, based on some of the economic data out today. There's really not that much data out today. That's why I figured I would talk about house prices and interest rates. So based on this, where are mortgage rates? Well, let's get over to this. These are where mortgage rates actually finished on Friday. Okay, what this is, you're seeing on your screen is the top 6 products people use when they're buying or refinancing a home. These rates are published by Mortgage News Daily. What they do, they survey mortgage lenders all over the country, and they ask them this question. They said, if you had a first-time home buyer buying their first home, it's a primary home in a single-family home, those 3 things, they have a 740 credit score, and they're putting down 20%. You don't need to put down 20%. You only need 3 in most cases. But they're putting down 20%. that's where the rate would be, okay? So if you're out there and you're like, Dan, I got a higher rate than that, what can I do? Well, I'm gonna give you information on how to reach out to us if you're just starting this process, or if you already have a quote, I'm gonna show you how we can analyze that quote for you. So, the one thing I want to educate you guys on, though, too, is credit. So I created a website about 10 years ago. It's called creditscoresandmore.com. Please check it out. It's phenomenal. It has a bunch of tools in here. If there's anything you want added to it you think would be helpful to others, let me know. I developed this website, and I can keep adding to it if I'd like. But let's go over to, if you're out there and you're really like, Dan, I'd love to kick the tires to see, can I qualify based on my credit score, my income? Do I have enough money down? Or can I refinance? Can I maybe get a lower rate? I'm looking to pull out some cash to pay off some bills. You might need a reverse mortgage. Your parents, your aunts, uncles. It might even be your situation. You might need a reverse mortgage. Before you say, no, reverse mortgage, why would I give the bank the house? I would probably guarantee that about 90% of what you know about reverse mortgages is wrong. But you can visit our website if you're out there looking to try to get some consultations. My name is Dan Frio. I'm a I hold a federal license, so I can help anybody throughout the entire country of the United States, all 50 states, as well as Puerto Rico. Best way to get us is hit the Apply Now button. What it's going to do is ask you a few questions and then set up a meeting with one of our mortgage consultants. If you're out there right now and you're like, Dan, I really love to just talk to somebody. How can I do that? Well, there's two ways to do that. You can give us a call, 844-775-LOAN. That's 844-775-5626, or you can shoot me an email. I get probably 50 of these a day. I'll be more than happy to email you back the answers to any questions that you might have. So thanks for watching, guys. If you would, please do me two favors today. One, give me a thumbs up if you like the value and see that there's value in this video. Also, if you haven't subscribed yet, please subscribe down below so every time I post video, you get an alert. Thanks for watching, guys. God bless. Hope to see you here tomorrow. Bye-bye.